Hi everyone, welcome to part 2 of the week 3 live chat here in Finance 4501 Investments. This time we're going to be looking at PE ratios and the basics of options contracts, calls and puts. The first part of our discussion will center on the price to earnings or PE ratio, a crucial metric in financial analysis and valuation. The PE ratio is used to measure a company's current share price relative to its per share earnings. It is a significant indicator that investors use to evaluate the market value of a stock compared to the company's earnings. Some key points to consider. Let's begin with the relevance of the PE ratio. The PE ratio offers a quick snapshot of what the market is willing to pay today for a stock based on its past or future earnings. A higher PE ratio may suggest that investors are expecting higher earnings growth in the future compared to companies with a lower PE ratio. Several factors influence the PE ratio. This ratio is influenced by two factors in particular. One, the required rates of return, often indicated by the letter K here. There is an inverse relationship between the required rates of return and the PE ratio. If investors require a higher return, they are likely to pay less for the stock, leading to a lower PE ratio. And then part 2, the expected growth in dividends. There is a direct relationship between the expected growth in dividends and the PE ratio. Stocks with higher expected dividend growth typically command higher PE ratios, as investors are willing to pay more for the anticipated increase in future cash flow from the dividends. Application in stock valuation. The PE ratio is used to estimate the intrinsic value of stocks. Intrinsic value is the perceived or calculated value of a company using fundamental analysis without reference to its market value. Conceptually, it is similar to the constant growth dividend discount model, or DDM, which values a stock based on the present value of its expected future dividends. Utilization by financial analysts and investors. The PE ratio is extensively utilized by analysts and investors as a tool for making investment decisions. Analysts, for example, compare the PE ratios of companies within the same industry as well as against the market as a whole to determine relative value. In short, the PE ratio serves as a fundamental metric in assessing the attractiveness of a stock as an investment. It reflects the market's assessment of a company's future earnings prospects and its dividend growth potential. Our discussion now shifts toward understanding the interplay between PE ratios and the inherent risk associated with stocks. The level of risk tied to a firm directly influences the expectations of investors regarding their returns on their investments. Some additional key points to consider include the following. Risk and required rates of return. Investors adjust their required rates of return, often denoted by the letter K, based on the perceived risks of the firm. The riskier the firm, the higher the required rate of return. This required return is pivotal in valuing stocks as it is used to discount future earnings or dividends when calculating intrinsic value. The impact of risk on PE ratios. There exists a natural risk-return trade-off in the market which is reflected in the PE ratio of stocks. Riskier stocks, characterized by greater business or financial risk, generally command lower PE multiples. This phenomenon is due to the market's lower willingness to pay for earnings that are considered less reliable or more volatile. Conversely, less risky stocks with stable earnings and growth prospects tend to have higher PE ratios. Significance for investors. Understanding the relationship between risk and PE ratios is crucial for investors when making portfolio decisions. It helps in identifying potentially overvalued or undervalued stocks. A lower PE ratio does not necessarily signify a better investment. Instead, it must be evaluated in the context of the stock's risk profile and the overall market conditions. Application and portfolio management. Portfolio managers often consider PE ratios in the context of a stock's risk when constructing a diversified portfolio. Balancing high PE, lower risk stocks with low PE, higher risk stocks can be a strategy for risk management. The PE ratio can be a reflection of the market's perception of risk associated with a company's future earnings. Investors and financial analysts use this ratio as a comparative tool to assess whether a stock is priced appropriately in relation to its risk. Pitfalls in using PE ratios. While PE ratios are widely used as an investment metric, it is important to address certain pitfalls associated with their use. Understanding these limitations is crucial for a comprehensive analysis of stock valuations. Some key points to consider include the challenges of earnings management. Earnings management refers to the use of accounting techniques to produce financial reports that may paint an overly positive picture of a company's business activities and financial position. This practice can significantly distort the PE ratio as it affects the E or earnings part of the ratio. Therefore, the reliance on PE ratios without scrutiny of the quality of earnings can be misleading. The importance of using pro forma or projected earnings. Pro forma earnings are adjusted earnings figures that include one-time items and some non-cash items, providing what some argue is a more accurate picture of a company's ongoing profitability. Calculating PE ratios using pro forma earnings can sometimes provide a clearer picture of the core operational performance, but it's important to ensure that the adjustments are reasonable and not excessively optimistic. Misinterpretation of high PE ratios. A high PE ratio typically suggests that the market expects higher earnings growth in the future. However, it does not guarantee higher stock returns. Investors might overvalue a stock due to excessive optimism about its growth prospects, leading to PE ratios that are not sustainable over the long term. The simplistic nature of PE ratios. PE ratios are often criticized for being too simplistic, as they assume that the future PE will remain at or near current levels. If the expected growth in earnings does not materialize, the PE ratio will decline, potentially leading to significant losses for investors who paid a high price for the stock based on an inflated PE ratio. When considering the PE ratio, it is vital to stress the importance of looking beyond the numbers to understand the quality of earnings, the assumptions behind pro forma adjustments, and the broader market context. By acknowledging these pitfalls, students can develop a more nuanced approach to evaluating stocks and avoid making investment decisions based solely on PE ratios. Next, we turn our attention to a brief overview of options contracts and how they work. There are two basic types of two basic types of stock options. The first is the call option. An option is a contract that gives the contract holder the right to buy or sell 100 shares of stock at a time, and the call option is the right to buy shares of stock, again in blocks of 100, at a preset price known as the exercise or strike price. Options contracts are temporary. They typically expire anywhere from 1 to 9 months in the future, sometimes as long as a year, maybe even 2 years, depending upon the stock. These are the normal contract periods. Specifically, the shorter periods are normal. In fact, many people who trade call options will do them only for a month or less. These contracts expire on the Saturday following the third Friday of the expiration month, right? So if I bought a call option that would allow me to buy shares of, let's say, Tesla. I don't even know if Tesla trades options. Let's pretend it does. And the expiration date on my Tesla calls was for July. Those calls would expire technically on Saturday following the third Friday. However, markets are not open on Saturday, so functionally it's really the close of business on that third Friday of the expiration month. You may and often will, if you trade options, sell those contracts before that maturity date arrives. This is the American form of options contracts. The European contracts actually require you to hold them until the expiration date. The short answer with a call option, it makes money for you if the stock price goes up, and it loses money or becomes worthless. The options contract, not the stock, but becomes worthless if the price stays below or falls below the contract strike price or the target price. Opposite the call option is the put option. This is a contract that gives the owner or the buyer of the contract the right to sell 100 shares of stock at a preset price. Notice it gives them the right to sell, but not the obligation to do so. Same is true with call options. So if you're wondering who would buy a put option, typically you might purchase a put option as a form of insurance against stock you already own, meaning that if the stock price drops, you could sell your put option and make money on that contract, even though the value of your stock has gone down in price. Some option characteristics. Going back to the call option, remember the call option gives the owner or holder the right to purchase stock. You can purchase up to 100 shares of stock per call contract at a preset price within a certain time limit known as the expiration date. So if a call option holder wishes to buy stock, they will then exercise the option. They may choose to exercise the option anytime up to and including the expiration date. At that time, the option holder must pay the agreed upon or target price known as the exercise price. And they pay that price to the option writer. The writer is a person who sold the contract and who owns the stock that is being purchased by the call contract holder. Exercise prices are typically adjusted if the stock splits or if stock dividends are paid during the time of the option contract. However, cash dividends are not adjusted. The cost of an option is called the premium. So rather than buying 100 shares of stock, I could pay a relatively small call option premium that gives me the right to buy that stock at a preset price. And when the stock price actually goes above that preset price, I get to purchase it at the lower price. This is the attraction of the call option. Or in lieu of actually buying the stock, I can simply sell my options contract before it expires, and someone else on the other side of that is buying that contract. They are assuming the price will continue to go up. I'm basically getting out with my profit in hand before the options contract expires. The underlying company, the stock, I used Tesla in my earlier example, but it could just as easily be any stock out there, Ford Motor Company, for example. The company itself is not involved. The options market is separate from the stock market. It trades contracts based on the price movements of the associated stocks, but that's where it ends. Other than if the contract is exercised, then yes, shares of stock are actually traded, but all of this happens in the secondary market. Therefore, the associated company is not involved at all and would not even be aware of what's going on, nor do the option contracts necessarily affect what's going on in the company's operations. Options are referred to as a zero-sum game. For every winner, there is a loser on the other side of the trade. It is simple as that. Some warnings about trading options. They are highly volatile and considered to be very, very risky. In fact, for an options contract to even become profitable, oftentimes, the option price itself may have to move 10 or 15%. Not necessarily the stock, but the options contract itself in a short time before the investor can recover the transaction costs and commissions used to purchase the contract in the first place. Options are by definition short-term trading instruments, right? An investor can oftentimes ride out bad times in spotty stock markets, or in stock markets, I guess I should say, but not in the options market. There is a limited loss feature that makes options appear safer than they really are. The limited loss feature being you paid a fraction of the stock price to buy the contract, but if the contract expires worthless, meaning if I buy a call contract and the stock price never goes above the target price in that contract, my call option expires worthless. The money I paid to buy that option is just gone. It's lost, right? So it is very important to compare the equal dollar investments in stocks and options to really see the higher risk of the options position. On the other hand, you can control a lot of stock with a small amount of money by trading options. And yes, that market is highly, highly competitive. So what's wrong with selling options? What about being on the other side of the contract where you're not buying the contract, you're actually selling it? In the options world, selling a contract is known as writing the contract. And you can use a relatively conservative method called covered call writing. This involves selling options against stock that you already own. In this case, selling call contracts against stock you already own. And the idea being, if I already have, let's say I have 100 shares of General Motors stock, right? And I don't really want to sell the stock, but I would be willing to sell it if I had to. So what I can do is sell a call option against my 100 shares. A call buyer is going to pay me the premium, which gives them the right to buy my 100 shares of stock at a preset price within the time frame of the call option. If the stock never rises above that preset price, as the covered call writer, I keep the premium and the buyer of the call option loses the premium. The opposite could also be true. If the stock does rise above the strike price as the writer of the contract or the owner of the stock, I would be required to sell my stock at a below market price because that makes it profitable for the call buyer. On the other hand, covered call writing, if you do it conservatively, can be a great way to generate additional income on stocks that you plan to hold anyway. Right? Of course, you could end up holding stocks that in the long run didn't turn out to be all that great anyway, right? Because the prices are not moving up very fast or at all. But if you believe in those stocks, and especially if they pay you dividends, you may not be concerned about increasing the stock price. You like the idea of generating additional income by writing call options, however. There is the ability to write calls on options you do not own. This is known as naked call writing. Generally, the brokerage firm will require you to put up an equivalent amount of cash, however, as collateral if you're going to write calls against stock that you do not own, because if the contract goes against you, if the stock price rises above the exercise price of the call option, you will be required to not only sell your stock, but you have to go buy the stock before you can sell it, which means you'll have to buy the stock at a current market price, which is higher than the option price at which you would have to sell it. Super risky, and until you are well known at the brokerage firm, they probably will not authorize you to do that, right? Because it can result in a limited profit but unlimited loss. Therefore, in highly volatile or risky markets, not recommended to do so. There are some charts in your reading that show how or when a call option becomes profitable. Basically, X on the horizontal axis represents the target or strike price of the stock. Once the stock price, again going to the right, once the stock price exceeds X, the value of the call option, which is on the Y-axis vertically, begins to increase. And as long as we don't get to the expiration date of the call option, Call someone who is buying calls could stand to make a very, very nice profit. And of course, their loss is limited to what they paid for the option. So for that reason, trading call options can be very, very popular. Can be lucrative, but as we said earlier, can also be quite risky. This brings us to the end of live chat part 2 here in week 3 for Finance 4501 investments. As always, if you have questions, email is a great way to do that. You may also call or text. And if you've not started on your final project, please do so. You have about 1 week left to get that done. We have 1 week of the class left, 1 week and a day or so, and then everything is due. With that in mind, I look forward to seeing your work, and I will see you online.